Thinking about investing in dividend stocks while interest rates are falling? Well, let's break that down with some straightforward insights. And right now, with interest rates still on the higher side, a lot of folks are parking their extra cash in things like GICs and things like high interest savings account because returns are still solid. Now, that might make sense for short-term investing goals or even your emergency fund. But here's the kicker. Interest rates, it's like a roller coaster ride. They go up and they go down. And it's really hard to tell when exactly they might go up and when they might exactly go down, but you can get a directional sense based on guidance from things like the Fed and the Bank of Canada. In trying to predict the market's next moves, it's a bit of a losing game. As those interest rates that were above 5% start to disappear, I'm sure you've seen all those emails from Wealthsimple being posted on Reddit that interest rates are now starting to fall on their cash savings account because of the moves that are being made by the Bank of Canada. And with all that being said, how should you react? What should your next investment move be? Should you start now moving all of a sudden into dividend stocks if you weren't already? Well, let's talk about that. Here's where dividend stocks come in. As interest rates start heading south, investors are looking for better returns as interest rates on bonds, on GICs, on savings, on checking accounts just aren't cutting it anymore. And that's when dividend stocks really start to shine, because they offer a steady stream of dividend income with the potential for growth on that stream of income, while cash returns on other investments are starting to shrink. Think of it like this. You have two groups of investors. One group has invested all their money in high-yield savings account, just collecting interest. Second group, you have dividend stock investors where they invest in dividend stocks. The first group of the interest-seeking investors are now worried because all their money is in interest-focused products, so as interest rates start coming down, their returns also come down because they're just not getting as much return as they were, for example, at 5% compared to 3%. While that second group of dividend investors, they're sitting back, they're collecting their paychecks, collecting their steady stream of dividend income, while the yields on interest are shrinking. And the companies that typically pay a dividend are more well-established, they're more financially stable, they have a better position along the products and services they provide. Think of it like they're like the adults of the stock market, reliably sending out those dividends even when times are tough. Companies like Google and Facebook are now also paying a dividend because now they're also a lot more established, a lot more stable, and they want to reward their shareholders by sending those beautiful dividend checks every quarter. So by investing in dividend stocks, you're now tapping into this beautiful gold mine with a potential for steady income, potential for capital appreciation, and a potential for that steady stream of income to grow as those companies continue to expand. Meanwhile, investors holding on to savings account are worried about their ever-shrinking yield. So let's summarize 3 key benefits of investing in dividend stocks versus interest income. One is that steady stream of income. Regular dividends means you can count on a reliable income stream. Think of it like getting a paycheck just for holding on to these stocks. Next, potential for growth. Companies that pay dividends are often well-established and profitable, meaning they've got a solid track record and potential for growth. Third is reinvesting those dividends. By reinvesting your dividends, you're going to buy more shares. You're harnessing the power of compounding. It's like that snowball effect for your portfolio. Now, there is a fourth benefit, which is tax. Usually, tax is more favorable on eligible dividends versus interest income. I've done a deep dive on this in another video, so definitely do check that out. I will leave a link for that video about tax on dividends in the description of this video, so definitely check that out. Let's talk specifics. What ETFs can you now get into as interest rates start to fall, and you can pick up the advantage of dividend-paying companies? The 3 ETFs that we'll talk about are VDY, XDIV, and XEI. These are funds that pool together multiple dividend-paying companies, reducing risk and providing you with instant diversification. So instead of you having to pick individual companies, doing individual research on, did you pick company A, B, C, what if that company cuts its dividend? You get a basket of dividend-paying companies. And if one company is not performing that as well, that company gets taken out of the basket and a new company gets put back in. So you don't have to do any research, you don't have to do any work at all. These ETFs will do the work for you. All you do is sit back and collect your dividend checks And the beauty about these ones is they pay monthly. They're able to sit back and collect a monthly dividend paycheck without having to do any of the legwork. The first one is VDY, which is the Vanguard FTSE Canadian High Dividend Yield Index ETF. That is a mouthful to say. But why I like this particular ETF is that it focuses on high dividend yield for Canadian companies. The next one is XDIV, which is the iShares Core MSCI Canadian Quality Dividend Index ETF. Also another mouthful. And this one targets high-quality dividend-paying stocks in Canada. Last but definitely not least is XEI, which is the iShares S&P TSX Composite High Dividend Index ETF. And why I like this ETF is because it offers a broad exposure to high dividend Canadian stocks. Take a look at this chart. What it shows you is how the dividend yield compares to now different interest rates. So for example, VDY, dividend yield of 4.43%, XDIV, just under 4.5%, and XEI is at 4.5%. So all three of these different ETFs have roughly the same yield at just around 4.4 to 4.5%. Now, if we look at a comparable high interest savings account from EQB, you're looking at between 3.4% to 3.55%, while Simple at the current interest rate is at 3.75%. That's if you have like over 500,000 invested with them. And Simply Financial, you can also get up to 3.75%. Again, that's if you had like $1 million with them, you can access that highest rate. And if interest rates start to fall, those yields, the ones in green, can go down even further. And the ones in blue, they're going to stay relatively stable at that 4.4, 4.5% mark, while the interest rates can come down. And when interest rates start to fall, companies in sectors like utilities and real estate, they really start to benefit because they typically rely on debt to fuel growth. And when interest rates start to fall, they have to make less interest payments, meaning more of their money stays in their pockets versus having to pay the bank on higher interest payments. And when they have to pay less on interest payments, their margins start improving because more money stays in your pocket versus going out the door as interest. And many utility companies and real estate companies, they typically pay a dividend. So when interest rates start to fall, the cost of servicing that debt is lower, their margins improve. All of a sudden, the stocks in these sectors become a lot more attractive. And it's not just utility companies and real estate companies. Generally, as interest rates start to fall, stocks often get a boost. Cheaper financing can improve a company's overall financial health, making borrowing more appealing. And when that happens, what these businesses do, they start investing more in their operations. They start investing more into their workforce to keep that workforce steady. And this can boost profits. And as profits go up, stock prices get that uplift. So should you consider investing in dividend stocks as interest rates are falling? My answer is absolutely you should consider dividend stocks because they can provide a higher rate of return versus traditional savings account and versus high interest products, especially in a low interest rate environment. It's a smart move to consider increasing your allocation to equities as they can generate higher returns. What you want to keep in mind is your risk tolerance and investment time horizon, meaning don't just blindly start adding more stocks, adding more dividend stocks to your portfolio without having to do your research, without having to understand how much more risk, because if you are going for stocks versus interest, there is more risk you have to take. More risk, more reward. That's generally how the stock market works. Dividend stocks are not risk-free. I would say that younger investors should have a higher allocation of equities because they have time on their side so they can afford to ride out the market volatility with those ups and downs. Because generally, over the long run, the market tends to go up. And if you have more time on your side, you're giving maximum time for those equities to do more benefit for you. And if you are closer to retirement, then that strategy shifts a little bit. And if you're thinking about increasing your allocation of equities, I would only do so ever so slightly because at this stage, you don't want to risk your capital falling when you need that money the most because you just have less time to recover from potential losses. Safety and capital preservation becomes the name of the game. Now, if you depend on fixed income to generate cash flow, at this point, maybe you want to start considering more dividend stocks because they can generate that capital appreciation. They can generate that steady stream of dividend income with a potential for growth. So in this environment, that could be a smart choice, especially when cash returns are now starting to drop. No matter where you are on your investment journey, dividend stocks can play a key role in navigating your portfolio through this lower interest rate environment, especially as interest rates go from the higher side and they start edging lower. If I had to leave you with one tip as I end this video, instead of chasing rates, what you should do is build a diversified portfolio with index funds, with ETFs that can provide you with capital appreciation, steady income, no matter what the rates are doing, whether they're up, whether they're down. The index funds, the ETFs will take care of you no matter what the economic situation is. All you have to do is make sure you do your homework, do your research, understand how much risk you're willing to take, and how much time do you have to get to your financial destination. And if you've enjoyed this deep dive on falling interest rates and learned something new, do me a favor, hit that like button on the bottom of this video. It definitely helps this video out and the channel out. And I know that you want to see more content like this. And if you haven't already, please hit that subscribe button and that bell notification icon so you don't miss out on any future content just like this. Don't forget to check out all the links in the description down below. I've got some great resources and items lined up for you. Plus, it really helps the channel for every link you click on. And don't forget to visit my profile on askme.com. Get your burning questions answered directly from me privately within 24 hours. That's all for now. I'll talk to you in the comment section.